Hello guys, you're welcome to Forex YouTube mentorship. Right? It's often said that when you cannot spot the liquidity in the market, obviously you become the liquidity. What does that mean? I will explain that in this video, right? And there's also another quote that says that market always goes to where it will hurt people the most. That simply means market is tend to go towards areas where it will hurt most people, because some of these concepts that is being championed everywhere on YouTube or some mainstream media with respect to trading are traps in disguise, right? So having said this, please, you need to pay attention to this concept, because this is the concept that as a smart money trader, if you don't understand it, you cannot be profitable with respect to your strategy. Irrespective of what your strategy is, your strategy should incorporate basically two things: market structure and liquidity. Maybe in the subsequent video, I will talk about market structure, how smart money looks at the market, how smart money views the market, right? And how a lay trader views the market. We'll talk about that in subsequent, but today we'll look at liquidity. So how do we go about this? Now, the first thing you ask yourself is, what is liquidity? So liquidity is defined simply by stop losses, right? So that means where our stop loss exists, that is where our liquidity also exists, right? Now let's say you enter a trade here, or let's say you enter a trade. This is your point of interest, and you're expecting price to come down here and you buy. You definitely know that your stop loss should be below this low. That is how smart money, that's how we place our stop losses, right? Now this point here is liquidity, because when price comes to this point, we expect it to go higher. That is what everybody expects price to do, right? So this point here is where liquidity exists, right? So does that mean you should not put stop loss in your orders? No, that's not what it means. Don't worry, I will give you some some things that like I said at the end of this video, that will help you to know the liquidity that should be of concern to you and liquidity that should not be of concern. It's not every liquidity that should be of concern to you. There are some liquidity that shouldn't be of concern to you, right? Now, having said this, what is the importance of liquidity? Okay, now the importance of liquidity, we are smart money traders. We know that smart money at the big banks, right, like JP Morgan's and so on and so forth. Now, liquidity, smart money need to activate the stop loss of existing orders in the market so that they can place their positions in the market, right? Now, what does that mean? Smart money cannot just place buy or sell just like that, the way we do it in our MT5. Instead, what they need to do is they need to like people that bought before, they need them to they need to take their orders from them. That is, they want buyers to force them to sell, then they will buy, right? Force them to sell. And that when you buy and your stop loss is active, is hit, it simply means that sellers took your position from, because you gave it to them, you gave your orders to them. Those are some elementary things you need to know about trading. That for every sell you place, there is a buy order, right? That for every buy you place, there is a sell order. So that is just a different ball game on its own. So having said that, smart money needs stop losses in the marketplace to enter their own positions. So what that simply means is that if smart money want to enter the market, for instance, let's say this is the market. What they need to do is they need to see where there are pools of liquidity, right? Where there are pools of liquidity, because obviously smart money will not monitor every trade in the market, because you have millions and billions of orders in the market. So what they will simply look out for is places where there are obvious liquidity levels, right? So don't worry, when we get to types of liquidity, you'll be able to spot areas where we have liquidity levels in the market, right? So we need this as smart money trader, because as a smart money trader, you don't know the concept of liquidity, you are missing out, right? So the next thing we look at is the types of liquidity. Please pay attention. Types of liquidity. There are so many persons, they give different types of liquidity. Some gives 4, some gives and so on and 10, whatever it is. But I will only give you 2 here, right? Those are the 2 I think are the basic ones or the major ones, so to speak. So we have the buy side liquidity. We have the buy side liquidity and we have the sell side liquidity. So I'll just put these 2 together. Sell side liquidity, right? Now let's look at buy side liquidity first of all. Buy side liquidity is the liquidity that is resting above previous day high or equal highs, right? So let me just put that in writing quickly. Okay, so buy side liquidity is liquidity that is generated by sellers with intention to be taken by buyers. So what does that mean? Okay, and we said that liquidity could be, this buy side liquidity could be equal high, double tops, old high, previous day high, ancient session high. It could be previous month high, right? It could be previous month high, could be previous week high, previous month high, previous week high, so on and so forth, right? It could be any of those. Let me just put that up in writing. Okay. Previous month high, previous week high, so on and so forth. So right. So what does that mean? Let's say we have market structure like this, right? And you have something like this. This is almost like a double top, right? Now this is a buy side liquidity. This is a buy side liquidity. Like I said, it's generated by sellers, right, with the intention to be taken by buyers. This is a buy side liquidity. So now to analyze this quickly, you ask yourself, what generated this move here? We know they are sellers, right? What generated this move here? They are sellers. So buy side liquidity is generated by sellers, right, with the intention to be that this liquidity should be taken by buyers, right? So smart money, once smart money triggers this, then the real move really will start. Are you getting that? So people that sold there, it's not as if they were wrong. People that sold there, it's not as if they were wrong, but market just took them out because smart money was not involved in this move yet, right? So this is buy side liquidity. Sell side liquidity is just the opposite of it, right? This liquidity is generated by buyers and taken by sellers, right? So let's say we'll have the reverse of it, something like this. Price comes back and takes this. So this is sell side liquidity, right? So this is the first type of liquidity we're going to look at. Then the second type of liquidity is internal and external liquidity, right? This is very, very important. Okay, so internal and external liquidity. Internal liquidity is located within the trading range, while external liquidity is located outside the trading range. What do I mean? Let's say this is a market structure, right? If let's say this is the extent to which the market has moved, this is our low, this is our high, right? So this is becomes our trading range. So that means that this is the range which we're looking at to buy or do whatever it is, right? This is our trading range. Now, any liquidity that is located within this trading range up to like below 50%, right? Below 50% when used of Fibonacci level, below 50% is our internal liquidity. So here we can say here is our what? Internal liquidity. Anything below 50% is our internal liquidity. Let's use IL to represent that, right? Now, while outside this trading range is our external liquidity. This is also an external liquidity, right? But does that mean that price will come here and take this? Depend on the market condition, right? So having said this, let's have a look at the types of liquidity. Now we're going to look at a trade example video, a practical example video to demonstrate this concept so that you know how to apply it in your trading. So let's go, guys. Okay, so let's see this quickly. Now if you check this very well, we can spot equal highs here. We have equal high there, right? Then if you also look at this very well, we also have another equal high here. Right, equal high. Remember our equal high, if you still remember what we said, that our equal high is equal to our buy side liquidity, right? It could be equal high, it could be previous day high, previous week high, so on and so forth, right? So what are you expecting as a smart money trader? You are expecting, since there are equal highs here and equal highs here, these are liquidity levels, right? So we are expecting price to come to that level and rate that level. So let's see what price we do now. We are expecting price to rate that level and start selling. You see that now. So price rated this high. So some persons that don't know the concept of liquidity will just seek to sell from this region and say, well, this is market structure, high, low, high, low. Then the person will mark order block like this, right? The person will mark order block like this. You see how price took this person out and it continues selling. So if you want to enter this trade, what do? As soon as market sweep that liquidity, you can use candlestick body to enter, right? As soon as the candlestick close, this bearish candlestick close below this, you'll be seeking to sell, right? Be seeking to short from here, then with your stop loss above that high. Then where are you going to be targeting? You also target another liquidity level. We have another liquidity level here. This is our sell side liquidity. That is our equal low. We have equal low there, which is our sell side liquidity, right? So you see this now, very powerful concept, right? So we're expecting price, if price takes that low, right, you can look at another equal low here. You see this now. So just be expecting price to tag this low. Once price tags this low, you see that now. See how price did there, right? It tagged this low. So someone that sold here, you see how powerful this concept is. Someone that sold here doesn't mean that the person doesn't know what he or she is doing. It's just that the person was unable to spot liquidity in the market. This is so important. You should learn how to spot liquidity in the market, right? Then we'll talk about our trading range. Trading range. Let's see this now. This is an example of internal and external liquidity. Let me just take this to this place. Now let me take you here. Let's see something quickly. Okay, let's see something quickly. Now this is our trading range, right? Where is our internal liquidity? We know that certainly if we use our Fibonacci level to measure it from here up to this point, we know certainly our 50% level is here, right? This is our 50% level. Somewhere here is our 50%. Somewhere else is our 50%, right? Now if you look at this very well, there are equal lows here. You see this now, there are equal lows there. So this, in this case now, is our internal liquidity, right? This is our internal liquidity. So we expect price to come here, rate this and go higher. Now, and that also makes this order block a high probability order block, because or the presence of liquidity. Don't worry, in my subsequent video I will teach you what makes another block valid and what makes another block not to be valid. So just stick around, guys, just stick around. There's a whole lot I have in store for you. So we know how this player, I've already seen it in hindsight, right? So you see price came, took that you see now price took this internal liquidity, come for external liquidity. Now to conclude this quickly, first thing you have to note is that after internal liquidity is taken, the price goes for external liquidity. We see that was what happened here, right? After internal liquidity was taken, this an external liquidity. Price came for external liquidity. Internal, external. Price will come again, take internal liquidity, maybe somewhere here, go for another external liquidity. Like that is how price we keep playing around, guys. So on the concluding note, first, please pay attention. Market structure. The first thing I want you to note is that market structure is king. Like, it's market structure that tells you which liquidity level you are to focus on or not. It's not all liquidity level that are necessary to us, right? When I deal with market structure, you will understand the liquidity level that you should know, that should be of focus, that should be of concern to you, and the one that should not be of concern, to you, right? Now, another thing I want you to note is that not all liquidity will be taken in the immediate. That is, market can do something like this. Let's say, the structure is bullish, right? And market can do something like this, create a double bottom, so like here, and market will still keep moving higher, right? So this, due to the fact that this is an equal low, doesn't mean that market will read it immediately, right? Market will only read it when the trend has changed to bearish, so it does not become our target, right? That is the second thing I want you to know. Then thirdly, which is the last one, is that smart money takes liquidity because that is how they get their orders filled, right? So having said that, I hope this video was insightful and very inspiring. So please don't forget to subscribe to this channel, turn on your post notification, because I post videos every Saturday. Cheers and God bless you.